Okay, it is 11 o'clock. We can get going. So, good morning, everybody. Busy show today because it's the first of the month, and we've got Andrew McHattie running through what happened over the course of October. And then I'm going to hand over to Richard Williams, who's going to be interviewing Bradley Biggins of Schroder Real Estate Investment Trust. So, news first. A few things to pull out there. I'm going to start with Bluefield seller income. We all talked about this last week, so it should be fresh in your minds, hopefully. And the share price has only just carried on going down for various reasons, one of which we're going to talk about later. So the discount is now heading towards 35%, and the notional yield 12 if it's still around to pay those dividends. So the board has now decided, having had some feedback on the proposals that we discussed last week, that it will simultaneously launch a strategic review and invite bids for the company. So that puts it into an offer period. And the manager says it will put itself up for sale alongside the trust. So we don't get this situation where the trust was going to buy the manager and you have this huge fight about is the trust paying a fair value for the manager or not. Understandably, I think, because this is what we were saying last time, the shareholders didn't really like this idea. And so we get rid of all of that. So somebody, if they choose to, can then buy the trust and the manager at the same time and combine the two afterwards. Or alternatively, they could just try and buy the trust. We'll see what happens. So because the way this is all structured, we won't see who's bidding until the board's ready to announce it. That's just one of the wrinkles of the structure. But anytime somebody can come in and just throw a public bid in to the mix, so we won't rule it out that somebody will actually just declare something while we're going on. So that's all good fun, and hopefully that will result in a much higher price for shareholders and something closer to NAV. But we'll have to wait and see. Ecofin, I'm going to mention very briefly. It's tiny, and I know most of you don't really care anymore, but it has been in this managed wind down process for a while now. It has already handed some money back to shareholders. One of its big assets that it's still got left is its Texan wind farm, which is the thing that caused all the problems. So if you remember, a tornado came through and managed to spare the actual wind turbines, but cut the power line. And they haven't been able to repair that since. So this thing was $29.9 million out of $56 million of assets left at the end of September, end of June rather. And so they've agreed to sell it, but the way that the deal is structured, it's quite scary, really. So remember, this thing's $30 million. They only need to get $12 million up front. They're also going to get another chunk of money based on the number of turbines that get upgraded to higher power output capacity. But they also need to get production tax credits. And there's obviously debate whether that's going to happen or not because of what's going on with the politics. But obviously they're hoping they will do. They've got until 31st December 27 to get all of these upgraded. If they can do that, they'll get $7 million. So that makes it up to 19. And then the balance of all of this is held in an escrow account, $11 million. But that falls for every month that the wind farm cannot generate the power cannot export the power that it generates. Now, the problem here is the line, because it's had problems. So they're going to get a reduction in the value of this escrow amount that accelerates as time goes on. So if it's fixed by 1st of January, there's nothing. If it fixed during January, they lose $13,200 a megawatt for the amount that's kind of curtailed by. If it's not fixed until 2027, all of that money's gone. So you can see the danger here. So as I said, the old line didn't get replaced. The temporary line's been unstable. That's why it's been curtailed down to 30 megawatts. When they announced the interim results, they said that they're hoping to get all this fixed by the end of 2025. So what I don't get, this is fundamentally I don't understand, is why would you do this really complicated deal with a really uncertain outcome? Because anything can happen. We know another tornado or something, and God knows. So why do it this way instead of just waiting till you fix the problem, hopefully only for a few more months, and then selling it? But there we are. That's the situation. So hopefully you're still not shareholders. Jemmy, I wanted to throw a good news story into the mix here because otherwise it just has me miserable all the time, and I'm about to be very miserable. So this is a good news story. It's something I hold, something I love. Its discount's still too wide, shouldn't be 10.6. It's doing very well. The results that came out today, tick, 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 it's outperformed both in NAV and share price terms. That just extends its leads over the benchmark over 5 years. Dividends going up again. That's been going up every year now since 2020. And it's generating the income naturally. So that dividend is covered by earnings, and they've built up revenue reserves since they started, about equivalent to about 1 year's income. So that means that if there's a problem, they should be able to keep their progressive dividend going. They've also been buying back stock because the discount's too wide, and that's added to the NAV. And they instituted a performance triggered tender if it doesn't beat the benchmark for 5 years. So I think this is doing all the right things. And importantly, the reason why I'm banging on about it really is because we've got this sort of shift for the JP Morgan emerging markets, where it's shifting to paying income out of capital based on the percentage of the NAV, which a lot of other JP Morgan funds do. I think it would be a total disaster if the board said, "Oh, I know, let's just knock these two together now because they're both income funds and they're both in emerging markets." This is a very different portfolio. It's run in a very different way. It works, and the other one sometimes works and sometimes doesn't. And I don't want to see this disappear. So now, the reason I was going to be miserable, subsidies. So the government just sort of fairly out of the blue, I think, has come out and said we want to change the terms of our arrangement for subsidies. And so we're launching a consultation which will be open for a month. And it's all about changing which inflation rate is used to calculate the amount that they pay under the subsidy for renewables obligations and for feed-in tariffs. And we want to make the change by April 2026. Now, this is a scheme that goes all the way back to 2002. If you remember, David Cameron said no more subsidies in 2017. And so it's closed to new subsidies already. And they're all for a fixed period. So they start to roll off from 2027. And by 2037, there won't be any more subsidies. So this has got sort of natural end date anyway. And because it's been pretty successful, they now actually support an incredible 30% of the generation capacity in the UK. So it's a sizable thing. Now, everybody knows, well, I mean, this is sort of nuanced thing, so maybe most people don't care, but there was a problem with RPI. The way it was calculated, it sort of, it results with a higher number than it should have done. And so the Statistics Authority said, we're going to replace it with CPI, including unoccupied housing cost, CPIH, and that's going to be our main standard for measuring inflation in the UK. And it said that we won't even bother calculating RPI under the old methodology from 2030. We're just going to shift it, keep it the same base, but shift it to the CPIH methodology. But the government spotted that there's a gap, and I'll show you how this works graphically. It's a fairly big gap. And they're saying, well, because we've been using RPI rather than CPI, and then they're talking about CPI, not CPIH, which is a different thing. This is just mean that generators have been overcompensated with the effect of inflation. And this is true, but we always knew it was an issue. It's always been reflected in NAVs. It was something that the government got wrong when it set the whole thing up, but it's a contract. This is the situation. And people who've been buying and selling these investment companies all the way through, so for years and years, have always known what the terms of the contract was and the amount of money that there was going to come to them, and this is all reflected in the NAVs. So this is how the charts work out, and you can see the gap between RPI and the two CPI measures there. Shifting to CPIH, which is something that I originally thought would be, well, I mean, it makes more logical sense if you're going to shift it to CPIH rather than CPI because it's more equivalent to RPI. But I still, there's no logical argument for changing the contract now, I think. So, but what they're proposing is, it's not like we're saying, we think maybe we've mucked up here, so do you think, we should make the change? They're saying we're either going to penalise you or we're going to really penalise you. So we're going to switch to CPI from 2026, which there is the grey line going on to the green line. Or we're just going to stop uplifting the subsidies at all until they get to a point where they would have been if we'd been using CPI all along. The logic, I just think that's completely wrong. But there we go. It will obviously save money because that's the point of it. They have been paying too much. So about £180 million in the first year, rising to about £460 million in 2031-32. And they're trying to say, we're doing all this for consumers and it will lower electricity costs for consumers. I believe that when I see that, really, because obviously the government's desperate for money, and maybe this is part of the reason that they're doing it. Now, there's an obvious hit to the NAVs of the trusts involved, and you can see what those are there. So under the first option, the hit isn't too bad, really. Worst affected there is Next Energy Solar, according to Investec estimates. Next Energy hasn't actually said how much they think the hit would be yet, but the Investec estimates weren't too bad for the others. On option 2, the worst hit is Bluefield Solar, 9.5% hit to NAV, which is really quite chunky. And I think they're basically, it's like sort of stick and a bigger stick approach, where they're basically saying cave into option 1 or you'll get option 2. So this is what the consultation says. So obviously, if you look at question 1, it's like, is a fair and more accurate measure of inflation? Yes, it's hard to disagree with that. And then it's saying, if you choose between the two options, which one would you choose? And obviously, everybody's going to go, well, option 1 works out better for us, so we'll have option 1. And then they say, well, what are the impacts on generators, consumers, and investors, and what alternative approach should be used? And the obvious approach to that is don't do anything. So I put the contact details in here because obviously I quite like to get some of you fired up and writing to these people. But the biggest thing with all of this is it doesn't seem like a lot, and yeah, maybe we could wear it as an industry and all this sort of thing, but it just creates this precedent that where the government mucks up when it does something, it can just change its mind and impose a new set of conditions on the contract. That's really dangerous, especially if you get a government that comes in and says, we should never be paying subsidies in the first place, you've got to pay all these back, or we're just going to stop paying them, or anything might happen. And because it creates this risk that anything might happen, inevitably anybody that contracts with the government in the future is just going to say, well, I don't trust you, so I actually want a higher return. And because we need so much infrastructure investment in this country and the government can't afford to pay for it, we're going to need that private capital to come in and finance it. And if all of them are saying, but we need a higher return now, it's just going to cost way more money than they're going to save by doing this. So I just think it's a really daft idea. I mean, to give you, we keep banging on about our industry and what we've done for infrastructure investment in this country, and it is significant. But just as one example, just this week, INPP said it inked its deal to help finance Sizewell C. Whether you think that's a good idea or not, I don't know. But basically, if you want to get Sizewell C built, you're going to need private capital. INPP is putting up some of this. It's doing it, as we discussed on a previous show, on the basis of a contract that actually gives it a pretty smooth deal, I think. It's all inflation-linked money, and it does seem to be all completely risk-controlled. But, it just creates this uncertainty that somebody will come along and say, well, actually, this is too sweet a deal, and we shouldn't have done it, and we're now going to change the goalposts. And, that's just really bad news. So there we go. Please do go back to that page and write to the government. So I'm now going to hand over to Andrew McHattie.
Thank you very much, James. I'm just going to do my slot here before I get writing to the Department of Energy, and I think that was you're exactly right. That was a subject well worthy of a little bit of grumpiness, because it does seem extraordinary that the government is moving the goalposts, as you said. Still, we'll have a bit of brighter news now and talk about what's happened during the last month, and these are the risers. Now, I think there's quite a good smattering of different things here. So quite a range of trusts. You can see some biotech trusts in there because there's been good news and lots of M&A there. We can see Schroder Real Estate, so we'll be hearing about that one. There's actually Gore Street Energy Storage Fund on there, where there's a lot going on in corporate terms. Both SABA and RM are pushing for further change there. And SDCL Efficiency Income, where SABA has a stake. And then there's some other things as well, including a couple of Japanese trusts on there, because we've seen a change of government in Japan and lots of positivity around that. So actually lots of really interesting things going up. And on balance, actually, the market was up and down over the month, but we did have a small net gain. So hopefully some of us have made a little bit of money. I will talk about RTW Biotech opportunities, because I think that has a couple of unique and interesting aspects for me to talk about. On the way down, we do have actually quite a bit of energy infrastructure on there, partly for those reasons James has just discussed. But generally, there wasn't too much going down over the month. We can see a little bit of a contraction in a couple of the commodities trusts there, including Gold and Prospect Precious Metals, which has been top of the risers for the previous 2 months, because we've seen the gold price just come off its peaks for now. But I think it's quite interesting. As I said, a lot of energy infrastructure. And I really think this potential shift in the subsidies is kicking the sector while it's down. And there's so much uncertainty now. We've seen Bluefield obviously putting itself up for sale as a result. So we'll have to see what happens. I think that sector is going to be in the news quite a lot over the coming months. A couple of other things that I've highlighted here. The ones in red are the ones I'll talk about. A couple of trusts I think that are perhaps surprising to see on the list of fallers. That's Nippon Active Value Fund and HG Capital Trust. So I'll talk about those two and why those might be interesting now. So RTW, first of all, I think this is a trust that has been on the market for a few years now, and it has changed its spots a little bit as it has matured. But I think in many people's minds, they still think of RTW as a very early stage biotech investor, and therefore a high risk trust that should be trading on a suitable discount that is sufficiently wide to reflect those risks. But I do think actually RTW is doing a decent job of explaining that it's a full life cycle investor. So it does make early stage investments. And when I say early, I mean really early. So sometimes it will actually form its own companies if it sees an opportunity in a therapy where no one's currently working, and they'll actually put a company together, find the executives and build that company. But they hold those kind of stocks, but they keep holding them right the way through to maturity, beyond IPO, until they feel that all of the value has been realized. And actually what's happened over time is that, of course, the portfolio has matured. So it's now made up of a higher proportion of listed mature companies than it was before. So it's about 30% unlisted now, which is considerably different from where it stood a few years ago. So I do think on that basis, there's a case for narrowing the discount differential when you're comparing RTW to the two other biotech trusts, so Biotech Growth Trust and International Biotechnology. But if you have a look at the chart on this slide, the discounts don't look that unreasonable. So we've got the Biotech Growth Trust on 7%. We've got International Biotechnology Trust on 11.5%, and RTW Biotech Opportunities on 14.6%, apparently. Now I say apparently because that's not the real discount. So let me explain that. The key here is that, and this is really historic because so much of its portfolio was unquoted, RTW still releases its NAV on a monthly basis. So that discount you're seeing there is on the basis of the last released NAV figure. So that was actually the end of September. And that's out of date because quite a lot's happened since then. So that's based on $2.12 per share. But since then, actually RTW has benefited from the takeover of Avidity Biosciences. That was a big holding, its third largest holding. And it came out, or the bid was at a 46% premium to the prior share price. So that's great news. But equally, there's a company called Unicure, which has fallen back very sharply. That's a sad case where the company announced a really major breakthrough for Huntington's disease. And now the FDA has pushed back and said, actually, we don't have enough data for that. So we're going to hold back on that. So there have been ups and downs here. And there was another up this morning, actually, when RTW announced that another portfolio holding, this one called Evommune, has managed to IPO in the US. That's 1% of assets, and the IPO was at a 20% uplift to the prior holding value, so more good news. There's a lot of moving parts with RTW, and I try to keep track of those. So I have a spreadsheet, actually, which tracks their major holdings. And as of yesterday, that was showing me that the NAV was actually up to $2.26 a share. I think it fell last night by about 3 cents. But that implies the discount is wider than we saw in the official Morningstar data there. So I think the discount's more like 19.8% here. So maybe that's interesting and one to have a look at. Let's move on to a couple of things that have dropped. Now, I'm a bit perplexed by this one, and I might just be out of the loop in the news flow, but I've tried to discover what's happened here, and I haven't really found out. Generally speaking, it's been a good month for Japan. There's been lots of great media coverage. The market seems actually pretty pleased with the new Prime Minister, Sane Takaichi. And I do think, actually, it's been a generally bright month for Japanese equities. The Nikkei 225 index is up 6%. But Nippon Active Value Fund, which does have a very concentrated portfolio, that's down by almost 10% in share price terms, not in NAV terms, over the month. And this chart here is a short-term chart just showing you the share price of Nippon Active Value in black against AVI Japan Opportunity in blue. That's a similar trust in many respects, based on a similar thought process about the evolution of Japanese corporate policy and the more shareholder-friendly approaches that they're trying to promote. And those two have moved in tandem for actually quite some time. But you can see here there's been a real break. So Nippon Active Value Fund has broken that correlation and now looks considerably cheaper. The same is true if you look at the discounts. So AVI Japan Opportunity actually on a very small premium to its NAV, and Nippon Active Value Fund has now dropped to an 8.5% discount. I think today it's slightly lower than that, but still about 7 to 8%. So a significant differential has opened up there. And the same is true if we look at Nippon Active Value's current discount compared to its own history. So this chart is a chart showing you the the share price in blue and the NAV in green. And you can see actually there have been moments before where the discount has opened up. So at the start of the year, in the first quarter of the year, a discount did open up, then it narrowed again. And for the last few months, this trust has been trading very close to NAV. So this does seem to be a significant shift. I've really tried to find out why, and I haven't been able to. So it's, I think, worthy of further investigation, and we'll see if there are any other developments to come there. It could just be that there's a big seller in the market, and that's not the share price. HG Capital is the other trust, the last one I'll talk about. This is well known as a very high quality private equity trust that really does have a fantastic track record. If you look back at any long-term statistics for the sector, HG Capital is very prominent near the top of the risers. Over 10 years, it's the fourth best trust out of all sectors in share price terms and fifth in NAV terms. So it really is one of the greats of the sector over that period. Very highly thought of. And for this reason, generally the trust has bucked this trend that we've seen for private equity trusts to be on wide discounts. HG Capital Trust has actually traded reasonably close to NAV for a while, but that again has shifted over the last month, and the discount has widened out. So it's come out to 13%. You can see from the chart there that there's no change in the NAV. In fact, that's slightly out of date, and the NAV is now 550 pence. So it's 10 pence higher than on the chart there. So we have fresh data. We had HG Capital's third quarter figures showing this 2.4% increase in NAV, more positivity around the underlying performance of the assets held, the underlying portfolio companies. So I don't see any problems there. And in fact, there could be some good news on the horizon. There's talk about a potential IPO for Visma next year, which is the trust's largest holding. So potentially some good news to come. If anything, you might think that would foster a narrower discount to NAV. So it does seem surprising to me that this has opened out. And I have noticed that the market has reacted, that there has been quite a bit of coverage of this. So Stifel stockbrokers, for example, have upgraded the shares to buy. And I'm obviously not giving any advice on here, but I do think it's worth considering if you're a long-term investor looking for some quality in your portfolio. So that's it for me on the movers. I'll hand back now to James or Richard to talk about property.
Brilliant. Thank you very much, Andrew. I don't get the Nippon active value thing either. It's a bit weird. Yeah.
It does seem curious.
It does feel as though there's the odd sort of person just selling stuff, sort of not really worrying about prices. Sometimes there is like a big seller out there, and you get some weird moves, but yeah, we shall see. Right, so there is the very important disclaimer. So I'm now going to bring in Richard, if we can get him on, and he is going to interview Bradley. Is Bradley with us?
I believe I've literally just been told he's experiencing internet issues. So
we'll wait for him to appear. But I shall put his that way off, and I shall give you control of the slides, Richard.
Thank you.
Perhaps while we're waiting, I'll just come back to you on that point you were making, James, about sellers emerging sometimes without us understanding why. And of course, there are worries about the broader market at this time and the valuation of US markets in particular. And so it could well be that some people are just moving out of the sector, and that can create these price anomalies, which perhaps we can benefit from.
Yeah, I mean, on HG, because it's quite techy, and it's the tech bit that's sold off a bit. So that might be the reason. But again, that just seems unlikely to me. So I don't know. We'll see.
Yeah.
I'm hoping we can get Bradley soon, but Are there any questions while we? There was actually, I've been talking to one of the viewers in the chat room. We should just maybe explore this a bit about subsidies. So I think I should explain there. So that the old ROC and FIT regimes have ended. That's gone. But the new ones, the CFDs, the way that they work, these auction rounds, so people bid in a power price that they're prepared to sell power to the government, or they're prepared to sell power at, and that price then supports them constructing whatever they're going to construct. So if it's an offshore wind farm, they need a slightly higher price. If it's a onshore wind, they can do it with a lower price, and solar is a lower again. And those power prices, once they're set, if the power price trends higher than that, then actually people are paying the difference into the CFD scheme, so which is effectively the government. So, and obviously if it's lower, then they're getting support. There have been quite extensive periods where the price has been higher, and actually that people have been paying money into that scheme. So the CFD thing was actually working in everybody's favour. But those strike prices, I think what I've seen is the AR7 strike price is actually lower than it was last year for AR6. So anyway, once we get more news on that, because we'll get some news soon about who won those auction rounds, then we'll talk about that a bit more in a news article.
And in the time, it just creates this enormous uncertainty, doesn't it? And so, if you are an investor looking for yield, or you're interested in the discounts in this sector because they are so stupendously wide, this is a massive off-putting factor, because you just don't know what's going to happen, and you can't assume that it will be the lesser of those two evils that you talked about.
Aha, we have Bradley. Very good. So I'm going to hand over to Richard. Actually, I'll just give Bradley control of the slides now. And hand over to Richard, and I will disappear. But thanks very much, everybody. I'll jump.
Thanks, James. Morning, Bradley.
Morning, Richard.
How are you?
Very well, thank you.
Hopefully,
how are you doing?
Yeah, good, thank you. Hopefully your internet's up and running now. So as usual, we'll give you a few minutes to sort of introduce yourself and the company to those that may not be as versed in it, and then we'll open it to questions and stuff. So over to you.
Great, sounds good. Thanks, Richard, and thanks everybody for taking the time to listen in to the presentation this morning. At Schroders, we think this is a really interesting point in time for the UK real estate market, and I think there are some really attractive points around Schroder Real Estate Investment Trust as well, and I'll take you through those as we flick through the slides. If there's one slide that you take away with you today, I would suggest it's this one. This is really the investment case for SREIT. So when we cut the slides at close of business on Wednesday, the dividend yield was 6.7%, and that's fully covered by earnings. So really attractive dividend yield there. But not only do we have this attractive dividend yield today, we think there's the opportunity for rental growth in our portfolio, and that's evidenced by our very high reversionary yield of 8.3%, which is more than 2% higher than the benchmark. As we get through the presentation, I'll explain what that means in terms of pound notes with respect to the dividend. We have a very robust balance sheet, which we believe provides dividend protection, and it gives us excellent visibility on our costs as we look forward and forecast the fund. Our average interest cost is 3.5%, and that is really underpinned by the strength of our long-term loan from Canada Life, which I'll touch on as we get through the presentation. The share price discount when we were cutting the slides was around 13%, and it's probably now closer to 11%. We still think that offers excellent value given the market recovery that we expect in UK real estate, the earnings growth potential in the fund, and also our evolving shareholder register. So thank you to those who have supported the fund. We have had enormous inflows from retail investors over the last few years, and the proportion of the register held by retail investors has grown strongly as a result. We've got a really clear strategy with regards to real estate, and I'll explain that more clearly as we go forward through the slides. For those who don't know us, we have a kind of high-level summary slide here just to set out a few of the key facts on the fund. So the portfolio value is around £500 million. The NAV is just over £300 million. Key point regarding sector allocation for me is that 64% of the portfolio is allocated to either industrial, which is almost entirely multi-let industrial estates, or retail warehouse, so some form of warehouse. We think there are really strong supply-demand dynamics for both of those sectors, not least due to the ongoing trends around urbanization, so more people living in cities, and our multi-let industrial estates tend to be located on the edge of city centres. And also online retail continues to steadily grow, and that creates opportunities on multi-let industrial estates. Regarding retail warehouses, people are definitely valuing more and more their time as a precious commodity, and they'd rather nip to the local retail warehouse, drive, park easily, visit a couple of shops, get a drive-through on the way home, and do that all very efficiently, rather than going to a town centre, which can be busy, difficult to park, or expensive to park. Investment performance is summarised in the bottom right-hand corner. I'm really pleased to say that we have again won the MSCI award for all UK and European funds that they track in real estate. So we won the highest 10-year risk-adjusted relative return for all UK and European funds, both in 2023 and 2024, which is our latest version of that. So I think that speaks to the underlying portfolio performance and the strength of that there. I think that's only possible because we are Schroders, so we have a large real estate platform. We have around £23 billion of AUM globally, around 11 or 12 billion pounds of AUM in the UK. We have sector specialist teams that are engaged on SREIT across offices, hotels, retail, residential, all the key sectors are covered. And it's that depth of expertise that's required to successfully manage a diversified portfolio in our view. And we think this differentiates us from many of our peers. I mentioned the balance sheet earlier, and really the key point here is that Canada Life term loan. So you can see the dark blue bar in the bottom left-hand corner. It's 129.6 million. It's got an average maturity of almost 11 years, and it's fixed at an average interest cost of 2.5%. So extremely attractive debt. Interestingly, because it is a loan, it isn't marked to market in our financial statements. But if it was, the actual fair value of the loan is £18.5 million as at the 30th of June, and that's not reflected in our NAV. So that's upside to the NAV. We also have a tactical RCF, so that's the red and green bars there. It's £75 million in total. We've drawn £54.5 million as at the 30th of June. Part of that is hedged, so there's an interest rate cap of 4.25%, but SONIA's actually below that today. So floating around 4%, just over 4%, and that means the average interest cost on the RCF is the same whether it's hedged or not, and that at the quarter end, so the June quarter end, was 5.9%. Overall, the loan to value, the net loan to value, is 36.5%, which we're comfortable with, but we are working to bring that down to 35% or lower. And as I said before, the average interest cost is attractive at 3.5%. For those that don't know us, we are very much focused on income and driving that dividend. And you can see that over the period shown, which actually starts when we undertook the debt refinancing. So that's why we have such attractive debt. We undertook this refinancing in Q4 2019. And you can see that on the left-hand side, we immediately increased the dividend to pass on the savings from that debt refinancing to our shareholders. And since that point, so 0.772 pence per share for the quarterly dividend, that's been increased by 16% to today. So strong dividend growth, and we're working hard to try to continue to grow that dividend for shareholders, because we understand most of our shareholders own us for that income. A bit more detail on the investment performance here. I've really just put out the bottom right-hand corner where you can see that we're outperforming on a relative basis over all time periods. So for example, over 5 years, we're outperforming the benchmark by 4% per annum. And that would have really go a long way to explain how we've won that 10-year award from MSCI Now onto the market. You probably would have seen this week that the Bank of England held interest rates at 4%. It was a tight call, 5-4 split amongst the MPC. And what we're showing on the left-hand side is what the market expects the path of interest rates to be. So the red boxes going from top to bottom indicate where the market are implying interest rates will go. So a couple of cuts from now to the end of 2026. But what's interesting, I think, about the chart at the moment is it's not very clear. So for example, in December, it's pretty much 50-50 as to whether it will be held or cut. Time will tell. And as the Bank of England said, it really depends on the outlook for inflation and the data that comes in around inflation as to whether they feel they can cut rates further. Of course, this is important for real estate because typically as rates come down, the valuation of real estate tends to go up. And we'll get to that on the next slide. Just briefly on the chart on the right-hand side, what we're showing here are the 10-year gilt yield. So that's the green line. The all property initial yield, which is the red line. So that's effectively your sort of going in income return on real estate. And then the blue bars represent the gap between those two lines. And as you can see in our forecast to the right-hand side, we're showing a tighter yield gap than what has been in place since the global financial crisis of 2008. So you can see from 2008 all the way through to sort of 2022, the yield gap is much larger. But our view is that that's because the gilt yield was artificially depressed due to quantitative easing, which is of course in the process of rolling off, and there's even some tightening. And we think that's sort of special circumstances. And if you look to the period before that, the yield gap was much tighter and more in line with what we're forecasting. And I'd also just highlight that with real estate, you have the opportunity for rental growth as well. So there's the opportunity for growth in your income, which is obviously not the case with the gilt. Now on to some market fundamentals that I'd like to highlight. And this underpins why we think now is an interesting point in time to invest in UK real estate. So in the top left-hand corner, you can see the progression of capital values for real estate. And what you'll see is the dotted blue line is an average for the whole of the UK real estate market. And since June 22, for 2 years thereafter, average values declined by 25%. And that is driven mainly by the sharp increase in interest rates from close to 0 to 5.25%, which was mainly through 2022. So, clearly after a 25% valuation correction, you might think there are some opportunities in the market. Now, what's really interesting about that cycle, in contrast to previous downturns, and you can see this in the top right-hand corner, if you look at the green line, that represents rental growth for the industrial sector from the peak of this cycle, so from June 22 through to today, whereas the blue and red lines represent the trajectory of rental growth post the GFC, so post 2007, and in the early 1990s. And you can see that even though valuations have been declining, rents have continued to grow in this cycle. So industrial rents, for example, up 20% roughly since the peak of the cycle. Whereas if you look to previous downturns, rents actually declined. So what that means is today there's a attractive income return on offer in UK real estate straight off the bat, because we've had this 25% reduction in values, but rents have continued to grow, particularly in those structurally supported sectors such as industrial, and we'd argue multi-let industrial estates in particular, and retail warehouses. Now, looking to the bottom left-hand corner, you can see the growth in construction costs, and these have risen sharply, particularly in the last 4 years. And what that means is the pipeline of new developments is very thin at the moment. So new starts in the centre of London, for example, are at the lowest level since the GFC. So of course, if there's no fresh pipeline coming through, that means that there's more demand for the existing space. So we'd argue that is positive in terms of rental growth drivers. And then the final chart to highlight is in the bottom right-hand corner, we're showing vacancy, but we split vacancy here between good quality grade A space, i.e. the red bars, and then sort of the rest, the blue bars, and you'll see it's much lower for the good quality space. And in some cases, so Leeds, for example, it may as well be 0. So what you've got is a nice income return following a 25% valuation decline, not much new space coming through, and then a lack of high quality space in the market today, all of which we believe will be positive for rental growth, which then brings us on to our next slide, which are Schroder's house forecasts looking forward. And you'll see that over the next 5 years, which includes 2025, which is almost finished, we've got an average total return of 8.1% per annum, which is slightly ahead really of the long run average total return from real estate. And if you look at 26 onwards, so from next year onwards, it's higher. And the majority of this total return is driven by income, i.e. the dark blue bar, but also income growth, i.e. that rental growth that I discussed in the previous slide, which is the key driver for the light blue bars, which are showing capital growth. So we're not forecasting much in yield compression. We're more bullish on rental growth. So any further interest rate cuts from the Bank of England will be very helpful with regards to our forecast. Now, in terms of strategy, it's, sustainability is a core tenet of our strategy, alongside all the other fundamental sort of real estate factors you'd consider when making an investment in real estate. And the key reason we highlight this sustainability angle is because we believe that focusing on that will really enhance long-term total returns in a real estate portfolio. And, in our investment objective, we now have a requirement to make a meaningful improvement to the sustainability performance of our assets while we hold them. But we believe that that will mean we get higher rental growth and therefore a higher total return. And, we've been running this strategy for a couple of years now, roughly. And what's great is we have lots of good examples of it working. So, you almost don't have to take a sort of my word on the theory. We can show good examples. And on the right-hand side, we've got a really interesting proof of concept. And this is Stanley Green Trading Estate, which is just south of Manchester. It's one of our largest assets by value. It's a multi-industrial estate. And we acquired this asset at the end of 2020. And what's interesting about it is there were 14 existing units. So they're typically EPC C, maybe D, a couple of Bs. And it also had a 3-acre development site. It had 40,000 square feet planning permission. We increased that to 80,000 square feet. And we made a conscious decision to really push the quality of that development. So to the best sustainability standards. So EPC A+ and BREEAM excellent ratings. And what we've seen as we've let up those 11 new units is that the rents we're achieving on them are 39% higher than on the existing estate, which is in the same place. So really, there will be some upside in rents because it's newer, but our view is a large element of that 39% rental premium is because of the green premium. And not only are we getting much higher rents on this estate, so as I said, 39% higher, we're getting more value per unit of rent because the independent valuer is applying a keener yield to these units. So for example, these new units are being valued at an equivalent yield of around 5.2%, and that compares to 6.25% plus for the older units. Now, question is, that's fantastic, you're getting high rental growth and a keener yield. Has it been profitable to spend that money for shareholders? Well, we think emphatically yes, and that's proven by the total return we've achieved on the assets that we've owned it, which has been 15.9% per annum. And that compares to 7.9% per annum for the MSCI All Industrial benchmark. So this has been a really strong performer and a great example of the strategy in action. Now, we announced our annual results to March on the 11th of June. And what I've highlighted here on the left-hand side is progress since then, and there's been really strong progress. So excellent leasing momentum. And lots of data here that you can sort of take away and read in your own time. But for me, the key points are that we are achieving rents on new leases or lease renewals and rent reviews that are significantly ahead of the previous passing levels. So for example, our lease renewals have been 18% ahead of the previous passing level, and our rent reviews have been 22% ahead of the previous passing levels. In addition, and a question we often get asked is, you have this fantastic rental reversion, so that reversionary yield I mentioned of 8.3%, which we will come back to shortly. Is it achievable? Well, what this data shows is not only is it achievable, but we are often exceeding it. So for example, our renewals have been 1% ahead of the June ERV. So we're already exceeding that June ERV today. And our rent reviews, sorry, the new leases have been 1% ahead of ERV as well. So we do think that rental reversion is achievable over time. We have made some disposals. There are 3 disposals that we've either completed or exchanged on. And the key point here is they are ahead or equal to book value. So that gives us confidence in our valuations and in our NAV. So for example, we sold an asset in Truro, 14% ahead of book. Asset in Leicester was 11% ahead of book. And an asset in Marlow has been 11% ahead of book. So, and that reference is as to when we strike the price, because what will often happen is real estate transactions take a number of weeks, even months. And we obviously furnish the value of all information they're required to make a valuation of our assets. So they are aware of the sales processes. They know where the bids are. They know where we are with the legal negotiations. So then we'll mark the valuation to match those agreed prices. The final point on the left is cost control. So we think that we have a really tight handle on our costs. So the ongoing cost for the fund are 1.21% for the June quarter. That's slightly down on the year end, which is great. But a really important point here is, effective from the 1st of October, we have changed our management fee calculation. So previously the management fee was 90 basis points on NAV. It's now going to be 90 basis points, half on NAV and half on market capitalization. And the rationale for making that change is to enhance alignment between the manager and the shareholders, so that our fee reflects the experience of shareholders. So we hope that that's appreciated. And given where the discount is, around 11-12%, that means our fee is 6% lower. That's a saving to the fund. And I'm sure that you'll get the world's smallest violin out for the manager in terms of our slightly lower fee. But we were really pleased to make that alignment. On the right-hand side, I've just shown 3 assets, and this is really to give you a flavour of what we get up to in our portfolio. We're very active managers. That's only possible because of the large team we have of specialists. And this is to give you assurance that we're working really hard to try to capture that reversion. Now, top left-hand corner, you can see St Anne's House, which is it's a mixed-use scheme in Manchester. So you have ground floor retail and then 5 floors of offices. It's in a really nice location on St Anne's Square, and it's near to the prime retail core. What we're doing here is undertaking an extensive refurbishment, and it really is extensive, of the basement, the ground floor, and the 5th floor. And to give you an example, so we had made a huge hole between the basement and the ground floor to include a spiral staircase to really take advantage of the space you had in the basement. We're adding wellness studios, podcast studios, meeting rooms, an institutional style reception. So it's a really great experience when you walk in the building. Now, the rationale for doing all of that is so that we can charge higher rents on the office space. And on the 5th floor, which we're refurbing, we're going to be quoting £28 per square foot, which is 74% higher than the previous passing level. So it shows what you can achieve with a more sustainable, attractive building where tenants are willing to pay higher rents. So in 4 years' time, we're targeting to double the rent here at this asset. So the passing rent's around £750,000. The target rent will be £1.5 million. And when we started the project around a year ago, we forecast an IRR in this project of around 13% per annum. So again, goes back to that profitability point. Great to spend the money, but is it profitable? we think in this case it will be. Top right-hand corner is Millshore Industrial Estate, which is on the edge of Leeds city centre. This is our second largest asset by value. To give you just a brief background on the asset, this has been a really strong performer since we acquired it in 2015. So it's delivered a total return of around 12% per annum, which compares to around 10% per annum for the MSCI All Industrial benchmark. It's a very large asset, as you can see from this aerial photo. It's got 460,000 square feet of space available to let. It's across 28 acres. It's close to the M62 motorway, and as I said, it's on the city centre, edge of the city centre. Interestingly, in Leeds, they've got a really low vacancy rate for industrial, so it's around 3%. That compares to just over 5% for the UK market overall. And what we have at the moment is we've just taken back one of the largest units on the estate, so it's around 50,000 square feet. We got it back in June. We're undertaking a brown to green refurb, just like we're doing at St Anne's, just like we did at Stanley Green. And we are aiming to increase the rent post that refurb by 86%. And actually it's under offer, and we're hoping to exchange an agreement for lease imminently on that one. So hopefully we can update you with our interim results on the 27th of November. And again, the question is, has it been profitable to undertake that significant refurbishment to bring the EPC up to an A? Our analysis shows it will be. So our appraisal shows a net uplift in value of 1.1 to 1.5 million pounds. So that's taking into account the valuation post works and post lease, and then all the costs to get there, including the current site value, tenant incentives, etc. So, we think that's a fantastic initiative. Bottom left-hand corner is Headingley Central in Leeds. You may know this. It's on Otley Road, and is the start of the infamous Otley Run for anyone who went to university in that area. So this is prominently located. It's a town centre scheme anchored by core convenience, retail and leisure, such as Premier Inn Hotels, Sainsbury's, the Gym Group. We've just opened a McDonald's there, 25-year lease with a break at year 15. And the rent on that McDonald's, so just to give you some background, so McDonald's have taken half the unit that Wilkinson's used to occupy. Now, of course, Wilkinson's went bust a couple of years ago. We split the unit in half. McDonald's has taken half. The other half is under offer to a national grocery operator who you'll definitely have heard of. And interestingly, the McDonald's rent is 28% higher than the previous passing rent on a per square foot basis. And then the final example I want to give, lots going on in the portfolio, so lots to talk about. But in the final example, in the bottom right-hand corner, is one of our retail warehouse schemes. So this is Churchill Way West in Salisbury. We've got 3 units there next to a Waitrose with a huge car park, so excellent lineup. Of the 3 units, 1 is let to Sports Direct, and the other 2 were let to Smith's Toys and HomeSense. And we let those leases run down to expiry because we felt that we could get in a stronger tenant. And what we actually ended up having was a bidding war between Lidl and Aldi, which meant we were able to push really attractive terms. Eventually, Lidl won the sort of auction. And what's really important to Lidl and important to us is the sustainability performance of the asset. So the works we're undertaking as we speak are to bring the unit up to an EPCA. Lidl will be installing PVs on the roof. And the bottom line is that the rent that Lidl are going to be paying is 67% higher than the previous passing rent on a per square foot basis. It's a 25-year lease with a break at year 20, which are a fantastic covenant. And I think that they're going to trade really well there. So again, watch this space for further updates as the works progress. And again, question, is this profitable? Well, when we undertook the analysis at the time, this was delivering a double-digit income return on cost. So we think absolutely yes. Now, interestingly, these 4 examples, whilst we have been incurring costs in terms of CapEx and our live examples, they haven't actually, the upside hasn't affected our P&L yet because the rents aren't yet coming in. So, this is upside to come. Very briefly on the portfolio on the left-hand side, we've shown some important metrics. Got a really diversified tenant base with more than 300 tenants, which is highlighted on the left-hand side there. That spread risks, obviously, across a broader base of tenants, and we think makes the portfolio more resilient. And then we've highlighted the really attractive income yield. So 5.6% net initial yield and an 8.3% reversionary yield. And I'll just show you what that means on my final slide coming up next. And I discussed the portfolio allocations earlier. And as I said, the key point, 64% multi-let industrial estates or other industrial or retail warehouse. Final slide from me, and this is just to kind of provide some context to that reversion. What does it mean in pound note terms? Because I understand these yields can be quite abstract. Well, our cash passing rent at the 30th of June was £29 million. Our reversionary rent was £40.2 million. And bear in mind that reversionary rent is determined by the independent valuer. So this isn't what we think it is. This is what the valuer thinks it is. And that reversionary rent is £11.2 million higher than our cash passing rent. In the context of our annualized dividend today of £17.5 million, you can see if we are able to capture that reversion over time, we should be able to make a meaningful impact on that dividend. In terms of steps to get there, well, we have fixed uplifts in our leases, so contractual fixed uplifts in our leases in the 12 months to June 26 of £4.3 million. More than half of that relates to our largest tenant, the University of Law, who are in rent-free until October, so they're now paying us cash rent again. We had agreement for leases exchanged as at 30th of June, so as those leases complete, and the conditions to the completion tend to be obtaining planning or completing landlord works. So for example, the McDonald's, we had some landlord works to complete. That lease is now completed. As those leases complete, we will get the cash to come through. There are some areas where we have the ERV or the reversionary rent, which is higher than the passing rent. So as rent reviews come round or as lease renewals come round, we should be able to increase the rents. And I gave the update on the metrics since our annual results on an earlier slide. And then finally, we have some vacant space, which we're working really hard to let. Bearing in mind, some of this space is vacant because we have refurbishments underway. So often you can't, or usually you can't have the space let whilst you're undertaking refurbishments, although that's not always the case. So I hope that gives you some colour around our reversion. And with that, I'll just leave some closing comments on screen and hand over to Richard for any questions you might have.
Yeah, great. Thank you, Bradley. Yeah, so just conscious of time, we've had quite a few questions come in. A lot of which that you've covered off during that presentation, actually, sort of around the brown to green sort of premium and how you've been working that. One of the sort of big topics, I suppose, at the moment across industries, but it's relevant for property as well, is the budget coming up. What do you foresee coming up there, and how do you think that will sort of relate to the property industry and to your fund as a whole?
Yeah, great question. And, clearly it's going to be a really important budget coming up at the end of the month. I think at a high level, investors will often look at the gilt yield, particularly, the 10-year gilt yield, as a bit of a yardstick by which to measure property valuations and, does property look attractive? And we showed that on a slide earlier. And so I think if markets are assured by the budget, if they feel that fiscal policy and the UK's finances are under control, that could be helpful for real estate if that brings the 10-year gilt yield down. So through the year, it's been the 10-year gilt's been as high as sort of 4.9%. It's currently around 4.5%. And in our forecast, we expect it to decline to 4%. But of course, we need some reassuring sort of actions from the government in this budget. So I think that's an important factor at a high level. And of course, inflation as well with regards to interest rates. So the Bank of England clearly probably want to understand the budget before, potentially cutting interest rates further, which could be supportive to property, not least because it brings the cost of debt down, which means, it could stimulate the investment market. So for me, I think it's more those high level macro factors that we'll be looking at.
Cool. Yeah. With you obviously had a couple of slides there on your asset allocation, the sectors that you're looking at and stuff. Are you happy with that at the moment, or are you looking at? I know you've been bringing down offices over the last few years. has it got to a point now in that sector maybe that prices are so sort of cheap, and like you said, with the supply, no new supply coming on, that may be a sector that you look at again?
Yeah, I mean, good question. So in terms of our allocations, I mean, we have to consider the strategy overall, which is to pay this attractive dividend yield. So when we're thinking about sectors and locations to invest in, we always need to be mindful that we need to be buying at a certain yield. So that's what is great about the multi-let industrial estates and retail warehouses, although retail warehouses are probably, the yields have come in a bit over the last sort of 18 months. You can buy them at attractive yields because they require very active management. You're required to take on property risk, void risk, tenant, you have to manage lots of tenants. So our multi-industrial estates tend to be regional and offer an attractive yield. So some sectors probably aren't really available to S-REIT. So for example, the very prime offices in central London or, historically, PBSA or even residential, because the yields are just too keen. So we're really happy with our multi-industrial estates and retail warehouses, and we have been investing most of our capital into those sectors, whether that's through capex or acquisitions over the last sort of 5 years. In terms of offices, the average office valuation, as we saw on the chart earlier, has declined by around 35%. Now, there's obviously good reason for that, with a sort of structural shift in my mind of hybrid working and a tendency to want to be in very central locations surrounded by great amenity with fantastic transport links, which has meant some office space is just no longer fit for purpose. But absolutely, there are opportunities in offices. Have to be really careful and selective. We really like our office exposure where it's in the big six, so Manchester, for example, Edinburgh. But yeah, as I said, it's really just about being careful, because just a final point on this, looking historically, or certainly in the last probably decade, the real estate sectors have been really polarized in terms of their returns. So industrial has been, phenomenally strong, driven by really clear structural trends, whereas retail has been the opposite. Obviously, the other side of that online retail trade. Whereas I think looking forward, that polarization will be less, and it's more about picking, stock picking within the sectors and getting that right. And actually, our house performance tends to be driven by that stock selection, which is comforting.
Cool. I was talking about brown to green then, and just as I said, that question came in about obviously, I'll paraphrase here, but sustainability has sort of moved down the agenda a bit now. So why would you bake sustainability objectives into your investment policy? Do you want to sort of put the case forward for why you do that?
Yeah, absolutely, and certainly, globally, there has been a sort of general shift, particularly driven by the US, obviously away from that. But property is different; it's a real asset. So, and there are real drivers behind why we're undertaking on this strategy. And as I said, fundamentally, it's because it will, we believe, help us deliver better long-term total returns. So tenants will pay the higher rent for a more sustainable property. That's because they want to keep their bills down. They want to attract their staff to the office and retain them. And they also have their own net zero carbon targets. And bear in mind, we're in the UK here. So they need good space, because often for many businesses, their real estate footprint is a large element of their carbon footprint. And then investors are willing to pay a keener yield for high quality sustainable space because it lets more quickly. There's lots of evidence for that. There's less vacancy, you get higher rents, and I've given some examples in our portfolio where we've seen that live. There's less capex risk, and there's less risk of obsolescence in the long run. So these big sort of structural factors mean that we think the strategy still stands. And like I said, the best argument I can give is to keep showing case studies where we are increasing the rents and where we are increasing valuations off the back of the work we're undertaking.
Cool. All right. the elephant in the room has sort of reared its head. We had a couple of questions on London Metric and their stake that they bought in the company the other week. Question here, can you elaborate on the discussions with London Metric and possible outcomes, and what defence mechanisms do you have?
I mean, as you probably understand, Richard, I can't comment on individual shareholders and what their plans may be. In terms of defence, I mean, it's not really something. We're always trying to do what's best for shareholders. So in my mind, what we're trying to do is what we can control, which is grow that rent, control costs, try to grow that dividend, deliver excellent investment performance, and we have delivered strong performance as evidenced by that MSCI 10-year award. That's a serious award to win. And I think if we look at the 5-year total return of SREIT, it's been very strong relative to peers. And if we look at the last year and the previous year, so 2020, so the year to June this year and the year to June the prior year, we're looking at sort of 30% total return in the year to June. I can't, if we can flick to the appendix, I've actually got the figures there. So yeah, it would be good just if we could show that performance slide which shows the total returns over the last 5 years. And so that's the best thing we can do, is just try to keep doing what is best for shareholders.
Yeah, so I'm just
that's the one. So you can see 30.5% share price total return in the year to June 25 and 19.9% total return in the year to June 24. And going back to the year to June 21, it was 70%. So clearly that was coming out of COVID. And then you can see in 2023, the year to June 23, that's the impact of that 25%, valuation decline. So, like I said, we just keep doing what we think we can do to deliver great results for our shareholders.
Yeah, cool. Okay, and then just to round off, I think we had a question on what you think the biggest risk is over the next year. Maybe if you could say what you think the biggest risk, but also what the biggest opportunity is for the fund and the sector as a whole.
Yeah, good question. I think for me, it's so transaction volumes have been a bit lower the last couple of years, last 2 or 3 years, and that's largely sentiment, both probably focused around the UK. And I think for me the big risk is I kind of get an email tomorrow that one of our big tenants has gone bust, for example. Now, it's excellent that this slide is actually shown on the screen right now, because the great thing about our portfolio is it's very granular in terms of the tenant coverage, and that's a function of the multi-let industrial estate. So no tenant, well, there's only 2 tenants that represent more than sort of 3.1% of the rent. So but yeah, that's what for me is the biggest risk, is if the economy, if growth, which is already quite low at around sort of 1.3%, I think it's the latest sort of forecast I've seen for this year. If that doesn't materialize and is lower and inflation becomes higher and businesses fail, that would be a big risk for us in my mind, given we're an income focused fund. And we need that income to keep coming in to pay the dividend. And in terms of opportunities, I mean, look, it's all about pushing that rent on where we can, undertaking accretive CapEx projects where we can, working with our tenants to deliver the space that they want and they're willing to pay more rent for, like we're doing with Lidl, like we've done with McDonald's, and like we're doing at Millshaw, where we've got that large unit under refurbishment to EPCA now, which is under offer but not quite exchanged. So working with tenants to create better space to drive that rent on and capture that reversion, I think is a huge opportunity in our portfolio, as evidenced by our 8.3% reversionary yield.
Brilliant, great. Well, thanks a lot for your time today, Bradley. That was really good. Run through of the trust. That just leaves me. I'll flip through the slides to tell you about what we've got coming up next week. So in the hot seat next week is Simon Barnard from Smithson. So we'll be back with the news and the interview with Simon next week. Hope you can all join us again. Thank you for your time.